Are you curious about one of the largest industrial real estate transactions in Houston this year? Welcome to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. Let's get right to it. Brennan Investment Group, a Chicago-based private real estate investment firm, has recently acquired a massive 1.3 million square foot industrial campus in Northwest Houston. This strategic acquisition consists of 16 buildings that were previously owned by Innovex, a global leader in subsea oil and gas equipment manufacturing. The campus is situated on 126 contiguous acres within a master-planned business park, offering unit sizes ranging from 11,000 to 450,000 square feet. These buildings, constructed between 1999 and 2018, are designed specifically for manufacturing operations, equipped with HVAC-equipped warehouses, bridge cranes, heavy power, IOS yards, above-standard clear heights, and wide column spacing. This infrastructure supports diverse industrial requirements and provides exceptional connectivity across the greater Houston region. The location is surrounded by a robust industrial ecosystem with more than 780 manufacturing businesses within a 5-mile radius, providing immediate access to a growing labor pool and a supply-constrained market for heavy industrial space. The acquisition aligns with Brennan's strategic focus on acquiring functional industrial assets in key United States markets, primarily from corporate owner users. Their goal is to enhance these assets through targeted capital improvements to attract a diversified tenant base and generate long-term value creation. According to Troy McMain, co-founder and managing principal at Brennan, this acquisition offers a unique opportunity to secure a premier industrial campus in Houston, thanks to its specialized infrastructure and access to a growing labor base. Kevin Brennan, Chief Investment Officer at Brennan, emphasized the rarity and strategic importance of such a facility, highlighting its alignment with long-term growth trends in Houston's industrial market. Michael Brennan, Chairman and Managing Principal at Brennan, stated that this transaction underscores their commitment to acquiring best-in-class industrial assets in key logistics and manufacturing markets nationwide. Partnering with PCCP, they aim to secure a competitive edge in one of Houston's most competitive submarkets. PCCP, a real estate finance and investment management firm, is excited to partner with Brennan on this transaction. They see this investment as a unique opportunity to secure a large-scale industrial portfolio, given the campus's connectivity, heavy power, expansive yard space, and proximity to a dense labor pool. Brad Hartstein, Senior Vice President at PCCP, remarked on the campus's scale and functional design, noting it as a solid industrial investment. Brennan Investment Group is known for its extensive portfolio across 29 states, encompassing approximately 57 million square feet. With over 5,000 properties invested in across the United States, Canada, and Europe, Brennan continues to co-invest with private and institutional capital to achieve outstanding risk-adjusted returns. Meanwhile, PCCP manages around $27.9 billion in assets under management and seeks to provide investors with attractive risk-adjusted returns through a broad range of funding options. Across the United States, small businesses are finding new opportunities in prime commercial real estate spaces that were previously inaccessible due to high costs. The national vacancy rate in shopping centers rose to 5.8% in the second quarter of 2025, driven in part by the ongoing failure of chain stores abandoning their leases. This increase in vacancies is easing rental pressure, although there are still risks for both tenants and landlords, as 50% of small businesses shutter within 6 years or less. Kimberly Blair, a wellness practitioner based in San Diego, observed an uptick in screen fatigue among her clients and decided to open a storefront location for more in-person sessions. She found a surplus of prime options due to the plentiful shopping center space, allowing her to negotiate favorable rental terms and lease flexibility, which benefits both her clients and her business. Throughout the country, small businesses such as health practitioners, yoga instructors, and artists are taking advantage of the availability of prime commercial spaces. However, experts caution that these opportunities vary by geography. According to a recent report from Cushman & Wakefield, the national vacancy rate in shopping centers increased by 20 basis points from the first quarter and 50 basis points from a year ago, indicating a softening demand that has eased pressure on asking rents. Although the rental market was weaker during the peak of the COVID-19 closures, the continued store closures and rising costs for tenants are expected to dampen rent growth in the coming quarters. Elizabeth Lafontaine, Director of Research at Placer.ai, notes that opportunities on Main Street are increasing for tenants beyond the traditional retail model. Opening up retail real estate, particularly in booming markets with high consumer migration, presents opportunities for independent retailers and boutiques. Lafontaine adds that malls are now more open to local businesses, especially those that are locally recognizable. Teresa Aird, co-founder and chief marketing officer of Offices.net, reports an uptick in small businesses taking advantage of vacancies in areas that were previously unaffordable due to pricing, particularly in hard-hit retail corridors like inner-ring suburbs and mid-sized city centers. Despite growing vacancies in strip malls, rental rates are still rising, though not at the same rate. James Bonacker, senior economist at Cushman & Wakefield, explains that while rental rates were increasing by 4% post-COVID, they are now closer to 2%. This flattening of rental rate increases, combined with increased vacancies, is creating opportunities for small businesses to expand into previously inaccessible commercial properties. Bonacker expects a rise in medical offices, spas, and other non-traditional uses for these spaces. The market has recalibrated with more store closures, opening up further opportunities for smaller businesses. Andy Lapointe, owner of Traverse Bay Farms, a local gourmet food business in Michigan, has experienced the benefits of chain stores vacating prime locations. He notes that when national brands leave, it is not just about filling the space, but reimagining it as an experience that reflects the local community. This approach offers a unique, lingering place that fosters a sense of belonging. Many small business owners are negotiating more favorable lease terms, including flexible lengths, partial fit-outs, and even rent-free periods. Some are opting for shorter, serviced or managed office setups to test a location before fully committing, balancing visibility and affordability while supporting local regeneration. Developers in New York are increasingly looking towards transforming vacant office spaces into residential units to address the city's high housing demand. The shift comes as the office vacancy rate continues to rise, exacerbated by the lingering effects of the COVID-19 pandemic, which has permanently altered work habits and reduced the need for traditional office spaces. This trend of repurposing commercial real estate for residential use is gaining momentum as city planners and developers seek innovative solutions to meet the growing need for housing. In Kitchener-Waterloo and surrounding areas like London and Cambridge in Ontario, similar trends are emerging, albeit at a different scale. The region has been witnessing a steady increase in demand for multi-family residential units, driven by a growing population and the influx of tech companies. This demand is encouraging developers to consider converting underutilized office spaces into residential properties, offering a potential solution to the housing crunch. In the United States, particularly in major cities like New York, the conversion of office spaces to residential units is seen as a viable option to address housing shortages. However, these projects come with their own set of challenges, such as zoning regulations, structural modifications, and financial feasibility. Despite these hurdles, the prospect of creating new housing opportunities in prime locations remains attractive to developers. As cities like New York navigate the complexities of office-to-residential conversions, there is a growing interest in how these developments can be tailored to meet the needs of urban residents. This includes considerations for affordable housing, mixed-use developments, and sustainable building practices that can enhance the livability of urban environments. In contrast, the Kitchener-Waterloo area, while benefiting from the tech boom, faces its own unique set of challenges in expanding residential offerings. Developers in this region are exploring innovative approaches to integrate residential units into existing commercial spaces, balancing the needs for economic growth and community development. Historic Kansas City buildings are finding new life through redevelopment projects. These initiatives are breathing fresh air into structures that have stood the test of time, preserving their historical significance while repurposing them for modern use. One such project is the planned conversion of the Moline Plow Building at 1015 Mulberry Street into 121 apartments, which marks the first phase of Samara Road's ambitious West Bottoms redevelopment. This transformation is indicative of a broader trend in Kansas City, where developers are increasingly focused on revitalizing historic buildings to meet contemporary needs. The movement to preserve and repurpose historic buildings in Kansas City is not just about maintaining architectural heritage, it's also about contributing to urban renewal and economic growth. These projects create opportunities for new housing, retail spaces, and offices, attracting residents and businesses to areas that may have been overlooked in the past. By investing in these redevelopment projects, developers are not only honoring the past, but also paving the way for a more vibrant and sustainable future. In contrast, Ontario's Kitchener-Waterloo region is experiencing its own wave of redevelopment, particularly in multifamily residential projects. With a growing population and an influx of tech companies, the demand for housing is on the rise. Developers are exploring innovative ways to integrate multifamily units into existing commercial spaces, similar to the historic building conversions seen in Kansas City. This trend is helping to address housing shortages while simultaneously revitalizing underutilized areas. While Kansas City's focus on historic preservation offers a unique approach to urban development, the Kitchener-Waterloo region's emphasis on multifamily residential projects highlights the diverse strategies employed across North America to address housing demands. Both regions are leveraging their unique characteristics to create thriving, sustainable communities, showcasing the importance of adaptability and innovation in the real estate sector. Major development projects are set to reshape Greater Washington, according to a recent article by Ben Peters from the Washington Business Journal. These initiatives promise to transform neighborhoods and create new economic hubs over the coming decades, marking significant shifts in the region's real estate landscape. One of the standout projects is the Viva White Oak, a sprawling 12 million square foot development that aims to create a new urban center. This ambitious project is expected to bring a mix of residential, commercial, and retail spaces, fostering a vibrant community that integrates living, working, and leisure activities. Meanwhile, the redevelopment of the former RFK Stadium site is another significant undertaking. Plans for this area include the creation of a mixed-use development with a focus on housing, retail, and recreational spaces, aiming to revitalize this part of Washington, D.C., and provide much-needed amenities for residents. In Northern Virginia, the Rivanna at Innovation Station project is set to make waves. This development will include residential units, office spaces, and retail components, creating a dynamic environment that supports both economic growth and community engagement. The proximity to transportation hubs makes it an attractive location for both businesses and residents. These projects are part of a broader trend of urban redevelopment in Greater Washington, reflecting a shift towards creating mixed-use environments that cater to diverse needs. By integrating residential, commercial, and recreational spaces, these developments aim to enhance the livability and economic vitality of the region. As these projects unfold, they are expected to have a lasting impact on the real estate market in Greater Washington, offering new opportunities for investment and growth. The focus on creating sustainable, inclusive communities aligns with broader trends in urban development across North America. Thank you for listening to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. See you on the next one.